Okay, so what I want to do is to have a look at VAT, and this subject area can be studied, the actual syllabus here being discussed will go all the way through to CTA level, Chartered Tax Advisor, but it's predominantly aimed at the Association of Tax Technicians, ATT paper for VAT, and also the CTA Awareness VAT module. And what the aim is to really have a very broad understanding of VAT in principle, and also get an overview that will enable you to actually look at VAT in a deeper setting. Sometimes the VAT legislation can be quite wide in scope, can be very nitty gritty, very detailed. So an overview, mind mapping the subject area can be quite helpful in terms of your own diagnosis, particularly when faced with questions. First thing we have to know about VAT, indeed any tax, is the imposition of that tax. What we mean by imposition is that each tax will have an imposition when it is actually applicable. So how we distinguish one tax from another is its imposition, its charge. And I'm not just talking about a rate, I'm talking about the type of transaction when this tax comes into play. And if we look at VAT, it's predominantly governed by the VAT 1994 Act. Okay, and this is a consolidated act, and what we mean by a consolidated act is that previous finance acts have been rolled up, combined, consolidated to get this VAT Act. So we've got one place instead of looking at finance act that go back to way back when and having to source each one of those. So that's the great thing about Consolidated Tax Act is it gets updated for the latest Finance Act, and anything it overwrites in part of the law writing process, it will supersede that previous Finance Act. So in terms of the imposition then, I've highlighted in yellow here, we've got a taxable person, we've got a taxable supply, and we've got the place of supply. So basically, VAT is charged when we have a taxable person that makes a taxable supply and that's its imposition. So the question becomes, what do we mean by these terms? So a taxable person is an entity, and that can either be an individual, a group of individuals, such as a partnership, or a company that is or ought to be registered. It is also one that carries on a trade or a chargeable activity in the ordinary course of business. So it makes these supplies in the ordinary course of business. A taxable supply is the provision, the transaction or sale of a good or a service. So what that means is if it's not a good or a service, then it's not a taxable supply, or it's not even a supply. The word supply is that is a good or a service. The word taxable is where we actually differentiate and distinguish between the types of good or services that are chargeable to VAT, because not every good or service is necessarily chargeable to VAT. If the tax legislation was simple and said, right, well, if you make a supply of good or service as VAT, then there won't be much more to it. But it's this word here that is prefixed to the word supply that actually creates the complications of the VAT legislation, of VAT as a tax. So we know that VAT applies then when it's a good or a service, and someone who is some form of entity or person is a chargeable person, and that is one who carries on a trade or who is or ought to be registered. Now the word ought means that even if you are not registered but you had met the criteria to be registered and therefore you should have been registered, it would still deem those transactions as being vatable. It just means you wouldn't have necessarily recovered the VAT on the transaction and therefore you'd be out of pocket for it. A taxable person is not someone who doesn't carry on a trade or chargeable activity. So, for example, we could ask the question, why can't I register for VAT? I don't carry on a business. I don't have a trade or any activity. Why can't I reclaim my Tesco receipt VATs? Why can't I reclaim my Asda receipt VAT on the receipts? If I could, that would be fantastic because my food bill would be 20% cheaper. And it goes with everything else, with fuel and everything like that. So, although I'm a person, am I a taxable person? Again, it's the prefix of taxable that actually creates this separate body of rules that, because if a person's making a supply, fine, we get that, but it's the taxable element, and what that is set by conditions. So, what we can summarize in terms of what VAT is in America, it's also known as a GST, a goods sales tax. Across Europe, it's known, as a sales tax. It's some form of transactional tax. It's what we know as an indirect tax because it's not charged directly on the person, but it's charged on the supply. Okay, that's how we differentiate between direct and indirect taxes. So the imposition is important because you need to be able to distinguish. If I said to you, someone received a dividend, is that subject to VAT? Well, if we look at the imposition, we know that immediately, although the company may be a chargeable, taxable person, the actual supply is not a good or a service, and therefore it's not within the scope of VAT in the first place. Now, if I said to you, is the supply of a cake subject to VAT, then we know it's a good, but the question is it a taxable supply? And that's where we get into the actual aspects of VAT and the complications of VAT and knowing what is taxable and what isn't. Dividends in the first place is an easy answer because we know it's not a good or a service and therefore it can't be subject to VAT. So if we have a look at the next part, which is looking at registration, if we look at supply in a bit more detail, when we're looking at making supplies or when a supply is made, there's a number of factors we have to look at. Again, it comes more down to the principle rather than getting into the nitty-gritties. The first thing is the types of supply. Is it a single supply or is it multiple supply? And there are rules to determine whether they are multiple suppliers. Why would we be interested in the concept of multiple suppliers? Because some aspects of that supply may not be subject to VAT. And if I as a business can not charge VAT, that's good because it means the end consumer, which is usually the likes of you and I, an individual who can't recover VAT, would not have to suffer the VAT, and therefore the product would be cheaper to that end consumer. So there's rules distinguishing between, in a given transaction, whether that makeup of that supply, that transaction, is a single or multiple supply. And if we can do that, if we can meet the multiple supply rules for it's a given transaction, then we're able to distinguish between VATable and non-VATable elements, which, again, as I say, can make our supply cheaper to the end consumer. The other thing is the value of supply. So what's the consideration? So when we look at the value of supply, consideration is always deemed to be gross, okay? And when we look at consideration, it's not just necessarily monetary. For example, barter transactions are transactions where no money exchanges hands. If I am an accountant, I can offer to do your tax return. You're a builder, you can offer to build a fence. Probably a bad example, but I was going to say build a house, but they're probably not going to build a house for a tax return. But what we're saying there is we're exchanging our services. That is an economic transaction. There is value attributable to those two elements. And therefore consideration is not necessarily always going to be monetary, because suppose we were only ever operating like that, then there's going to be economic gains for both parties, but they're never going to suffer tax because no money's crossed hands, but they've still got the benefits of what that money would have bought, being able to purchase, that purchasing power. It's just not in non-monetary form. And therefore, it's common throughout the concept of taxation, which is ultimately derived from economics and law. If there is, that's why we use the word consideration over money. Consideration can either be money or non-monetary. Okay. These are important because, like I say, we can distinguish between the suppliers, but also how we value a supply is not always going to be an invoice value. It could be an equivalent value from if we're looking at non-monetary stuff. And if I didn't tell you, we don't consider non-monetary monetary, that distinguish not drawn at the imposition stage, then you'd carry on without appreciating that. So tax points are the points in which the tax imposition occurs. Okay, we have a BTP, which is a basic tax point, and we have a different basic tax point for both goods and services. So usually the tax point, so when VAT is to be recognised, and thus when it will be included on either respective VAT returns for the company or the other company purchasing. If not, if it's an individual, then that wouldn't come into play. But the tax point for goods is when the goods are dispatched. And for services, it's the date the service is performed. However, we have an early override and a late override for both of those, and we'd say we'll actually shift the tax point earlier if the payment is received before the goods dispatched or the service is performed. And we'll shift it after the basic tax point if the invoice is issued within less than 14 days. So what that means is if I dispatch the goods on the 1st of the month, but I invoice it on the 7th of the month, because that's within 7 days, we'll take the invoice date as being the tax point for VAT. Likewise, if I paid for a good, so I may pay for something on Amazon, I pay for it now, but I've not yet received, it's not yet been dispatched, or it's not yet been received by me. The early override means that actually the tax point is created when the cash has exchanged hands. Now, deposits, if we are having payments on account, deposits, particularly maybe perhaps more for services, they have their own tax point. So the tax point is when the deposit is paid. And equally, well, similarly, with continuous supplies, which are given in the nature of the world, there's a continuous element to the nature of the supply. It's earlier of the cash in the invoice. Okay. If we move to the next, which are types of supply. Okay. So with types of supply, I said before when we're looking at imposition, I said that, the word is taxable supply, and we know that supply is given as a good or a service. We know taxable is to determine whether there is a charge on that good or service or there's no charge on that good or service. And this is what we're looking at here in terms of the types of supplies. So what we say is when we look at a supply of a good or service, there are two types of supplies, a taxable supply and an exempted supply. And then when we're not supplying a good or service, it's simply outside of the scope of VAT. It doesn't come into it because it's not a good or service. So if we ignore that for a moment and we say, right, there are two types of supplies, taxable and exempt supplies. Exempt supplies are ones that are not taxable supplies but are still a good or a service. Okay, and these are specifically listed. So these are listed within the VAT Act as to what is exempt. Taxable supplies are split into three categories based on the rate of VAT. So standard rated is currently 20%. I've known it to be anywhere between 15 and 20%, 15% during the economic recession of 2008, 2010. Then we had 17.5% was prior to that, and it went back up to that, and then 20% during the recovery from the recession. It still is 20%. Zero rated is a rate of VAT, despite it being zero. Do not confuse 0% with an exempt supply which has no percent, and outside of the scope which does not have a percent either. 0% is a rate of VAT for a taxable supply. It is not to be confused with zero being an exempt supply, because it's 0% VAT. There is exempt VAT, which doesn't have a percent at all, and there is zero rated VAT, which is a percent, which is a rate of VAT, which is a taxable supply. The reasons we have these will become more understandable later on when we go through the different aspects of when this comes into play. But what tends to be said here is that whatever is an exempt supply will never become a taxable supply. 99.9% certain, because of the nature of the supply. A zero rated supply may one day, or may not, may flick between standard rate and zero rated, depending upon economic policy of government, depending upon whether they want to make a particular good cheaper. They can use that zero rate to say, yeah, we still recognise it as a taxable supply because it is, but we just move it into zero rate. Or so it tends to do that for economic benefit. Your reduced rate is 5%, and that's for domestic fuels. And your 5% and your reduced rate does come into play for property VAT. So there's a different schedule within the VAT Act. There's each respective schedules pertaining to what is a zero rated or a reduced rated or a standard rated supply and exempt supply. It will not look at or will not have a schedule for outside of the scope because it's not within the VAT regime. So I think what's important is to understand the imposition, understand these different elements that make up the imposition, because it's the understanding of these principles that will enable you to understand the rest of the actual detail when we look at the Act, and to conceptually appreciate the charge to VAT. Thanks a lot.